Hey everyone, I'm Alex Nottingham, and I want to talk to you about the permanent portfolio, what it is, how you use it, and why I use it. So let's start with a few concepts. There are Warren Buffett. We all know Warren Buffett. He's one of the greatest investors of our time, and he has two rules. The first rule is don't lose money. The second rule is don't forget rule number one, don't lose money. So it's really important when we're investing to avoid these big losses. So the objective of investing, or why I invest and why I like the permanent portfolio, is the following. You want a safe way to invest. You want to get somewhere between 7 to 9% returns with minimal drawdown. The reason you want 7 to 9% is you want to be able to have enough gains that you overcome inflation. You're not losing money on your investment. Also, part of investing, you want to get those gains, but you also want to protect yourself from what's called a black swan event. This is something we may or may not know is going to happen, or it happens, and it's something we haven't prepared adequately for. So 2008 was a financial crisis. In the 2000s, you had the dot-com bubble that popped, and it was devastating for a lot of people. Also, how do we handle unpredictable markets? They're all over the place. We don't know when they're going to go up or down, and that's something we want to prepare for. So here's what I've tried. I've tried dividend stocks. You buy a bunch of stocks and they pay you a percentage and you hope you're safe because they're conservative. But what happens is if they're not doing well, they cut dividends, and they're also subject to market downturns. So you may or may not get the dividend, and the stock can go up and down, and you're at the mercy of the markets. I also tried the S&P 500, which are basically a proxy for the total market. These are the top 500 companies, and they've done well over 100 years, but they are also subject to a lot of volatility. I also have a lot of cash, still do, and I'm moving into the permanent portfolio, which I'll talk to you about, but lots of cash is fine, but inflation hurts you, especially if you're not getting a high enough interest return on your money. I've tried option strategies, protective puts, collars, calls, all these things, and they can be used to actually be protective, but the problem is they're complicated, they take a lot of work, and they don't always end up giving you what you want because you're betting something is going to happen. Again, you're speculating. I tried this concept of the income factory, where I buy high income producing companies. This isn't dividend stocks. These are companies that have to give you a return on their profits, but they're also subject to the markets and drawdowns and ups and downs. And they have a hard time coming back because they're giving you all their income. So here's what I love. I love incremental growth. I love protection of wealth. I love consistency and simplicity. These are all factors that are important to me. So the permanent portfolio is quite simple, and this is how it's done. And by the way, this was developed by Harry Browne, and this concept was developed in the 1980s. And Harry broke up these asset classes that we're going to talk about into four, and it's very simple. 25% total stock market, 25% long-term bonds, 25% gold, 25% cash. That's it. It's simple. Now, is that the best allocation? We don't know, but sometimes simplicity is helpful for us to understand because we can't predict what allocation, how much of each is going to we need. As you'll see, there are different seasons where one of these asset classes performs quite well. So here's economic strengths as we look at each asset class. When you have prosperity, stocks do very well. Your economy is growing, interest rates are stable, inflation is low. Well, stocks do well, but when you have inflation or crisis, gold does well. That's when inflation is rising, the dollar is weakening, you have political instability. Then we look at long-term treasuries from 20 to 30 years. This you can purchase from the Treasury. There's different ways you can do that. But when it comes to long-term treasuries, they do well in deflation. Interest rates are falling, inflation is low. Then if you have a recession, you want cash. because there's economic uncertainty, interest rates are high. So depending on what's happening in the marketplace, and some of these can happen, many of them can happen all at once, or they can move around, is you want some asset class working for you to help you when they're doing well, and to have a firewall that if one of them do or two of them do poorly, that doesn't bring down your entire portfolio. You basically want to own something in the market that somebody's going to want, essentially. A strong product mix, a strong asset mix that's ubiquitous, that's evergreen. Take a look at the performance from 2000 to 2009. This is the S&P. This is the total stock market. The market, the US market, averaged in the decade of the 2000s a negative 1%. So for a whole decade, you made less than 1% or negative 1% on your money, including dividends reinvested. And during this time, you would have seen a moment where the S&P 500 dropped 50%. So your portfolio dropped 50%. Now, on paper, we love the market. It does amazing, the stock market. But when it doesn't, can you handle that volatility? That is what is scary about the markets. Now, the permanent portfolio during this decade did 6.79%, nearly 7%, with the market, the equities going down big during that time. Let's look at 1978 to 2022, as far back as we can go based on some back testing. And we see that the permanent portfolio averaged 8.5%. Equities did 12%. Equities completely, of course, outperformed. But look at the drawdowns. You had a 50% drawdown at one point with equities. Could you stay and hold your stocks? With the permanent portfolio, you only had a drawdown of about 14%, the worst. And the worst year for the permanent portfolio during 50 years was almost 7%, whereas the S&P 500 had a bad year of nearly 40%. Now, I want to note, in 2022, we had where both bonds and the stock market went down pretty hard, but the permanent portfolio still won, where it had a drawdown or it had a bad year of negative 12%, where the S&P only was negative 18%. So over time, and in general, the permanent portfolio doesn't have that bad downside compared to the S&P. But if you can handle volatility, stay with the S&P, unless you get a decade or two where the market does not grow. So the books I would recommend you take a look at, you could start with Fail-Safe Investing. This is Harry Browne's, one of his books, and it really gives you a simple way to investing, some great principles, as well as beginning this concept of the permanent portfolio. If you want a detailed analysis of what the permanent portfolio is and how to utilize it, then Craig wrote a great book, Craig Rowland, called The Permanent Portfolio, and it goes into great detail about how to use it, how to execute this permanent portfolio, so that if you want more detail onto that, it's beyond the scope of this presentation. Here's some key lessons from Fail-Safe Investing by Harry Browne is, number one, build your wealth upon your career. I'm making money from my career. That's where principally, unless you're a investor, that's what you do for a living, and you're really good at it, which I don't know who really is. Few are, and there's a lot who lost money, but your money is what you do. You don't want to lose that money from investing. We talked about rule number 1 and 2 from Warren Buffett. So with that money, you want to preserve it. That's where you make your money. Investing is going to help you maintain the money, grow it to beat inflation, so you can live on that in the future. But that's the baseline. Rule number 9 in the book, do only what you understand. If you don't understand what you're investing in or where your money's at, then don't do it. These 4 asset classes, you can understand. You may not know why they move, but you can get a sense of what affects them. They're very dumb, meaning they're broad. They work as they work. There's not a lot of speculation in them because they're their own entity. But once you get into funds that have these crazy rules, we don't know what is what, and you don't understand them, so therefore I wouldn't invest in them. Rule number 17 in the book, whenever you're in doubt, err on the side of safety. If you got to be more cash or more treasuries, whatever, stay safe. Yes, we have FOMO, fear of missing out. If we missed a great investment, certainly that has happened, but you don't want to gamble. Better you're safe and you're comfortable in what you're investing in. So here is some do-it-yourself portfolio options. I'll start with the one that you actually do it. And you can invest as follows. You take your portfolio, you invest 25% in the S&P 500, which one of the tickers is VU or VTI, the total stock market. You take another 25% and you invest in long-term treasuries. That can be TLT or VGLT. You can do 25% in BIL or VBIL, which is Vanguard's short-term treasuries, which basically is cash. And you can do GLD or GLDM, which is a little less expensive, which is gold and ETF form. And then you will rebalance it whenever it gets out of whack, maybe once a year. There's not much you have to do. This is a do-it-yourself portfolio, and the expenses are very low when it comes to writing it because you're doing it yourself. You just have like an infinitesimal expense ratio because of the funds, but you're saving a lot of money in fees. Now, if you don't want to have to rebalance and pick those, you could actually buy a fund called PRPFX. It's called the Permanent Portfolio Fund. So this fund was created in the 80s, I believe, and it mirrored Harry Browne's original permanent portfolio model, which include silver, Swiss francs, real estate, and so on. So it's a little bit more complex than the new permanent portfolio that's simple, 25, 25, 25. The performance between the 25, 25, 25 and this have been very similar over the years. One outperforms the other depending on the decade, but they're close. This is the closest thing to just buying it. So you can buy the mutual fund and just set it and forget it. And it, much like the permanent portfolio that you do yourself, the drawdowns are very low. It's not volatile, and it's got a nice growth ratio. So you can see the back testing when it comes to it. So this is a good option as well. It's all about the bad years. Look, it's easy when things are flying high, it's great. Of course, who's going to say no to more money and more growth? But it's the bad years that you have to be able to overcome. So in 2022, we saw that the S&P went down negative 18%. Permanent portfolio, negative 5.4%. Look at 2008. In 2008, permanent portfolio, negative 8%. The S&P 500, negative 37%. Ouch. I don't know about you, but I'm okay with a 5-8% drawdown or end of year when it comes to my portfolio. That I won't lose too much sleep over it. But 37%, ooh, and it had a drawdown of 50%, that's going to be hard to swallow. That's going to be a very difficult night or year or years, and having to come back from that, it took a long time to do so. Look at the 2000s. In the 2000s, 2000, 2002, big negatives for the S&P 500. Permanent portfolio is up every year, even as high as 14% in 2020, 2002. So you want to see first, how do the bad years play out? And you want a portfolio and a model that's protecting you from that and protecting your wealth, and then you focus on the gains. So here are some rules to live by when it comes to investing. First, live below your means. This way you always can deal with how the markets shift and how much wealth you have, because you can save more and you don't have to burn as much money. The second is avoid big loss. A buddy of mine, Rob, who's an investor, taught me this saying, which I like: avoid big loss first, because that messes up your livelihood. You want to avoid that at all costs, and it's so difficult to come back, especially if you don't have the time to come back from that loss. And after you avoid big loss, make as much money as you can ethically. So that's the permanent portfolio, and I hope you enjoyed it. I certainly enjoy it. And until next time, go out there and be an all-star.